Good morning, happy Friday, and welcome to The Business Show, your go-to source for money and finance news in 10 minutes or less every day. I'm Andrew Gincola, and today we're covering the Boston Celtics record-breaking $6.1 billion sale and what it means for the NBA and the franchise's future. And Klarna's big partnership with DoorDash ahead of its IPO. Will this boost its valuation and disrupt the buy now, pay later market? And why Domino's pizza prices have barely changed in 26 years and how the chain stays profitable. And then what happens when the Fed actually raises or lowers rates? Interest rates have been a hot topic this week, so we're going to actually go through the specifics on what happens when the Fed either raises rates or it lowers interest rates. All that and more next. Let's get down to business. So the Boston Celtics sold for a record-breaking $6.1 billion, and we want to figure out what's next for the iconic franchise. So the Boston Celtics just made history, selling for a staggering $6.1 billion to private equity mogul Bill Chisholm and investment firm Sixth Street Group. The acquisition marks the largest sale of an NBA team ever, outpacing previous records by billions of dollars. Now, Bill Chisholm and Sixth Street Group have agreed to buy the Celtics for that $6.1 billion, setting that new benchmark for NBA franchise valuations, because each and every single time a team sells, a lot of times this raises the bar for the next franchise that's going to sell. Now, the record-breaking deal highlights the growing interest of private equity firms in sports franchises, especially those with global recognition like the Celtics. The sale is expected to close by the end of the year, pending approval from the NBA Board of Governors. Now, the sale price emphasizes how valuable iconic sports franchises have become, especially as media rights and global marketing opportunities expand. And this acquisition showcases how private equity firms are increasingly eyeing sports as lucrative investments. Now, with the new ownership comes new opportunities and potential changes. Will the team's performance on the court reflect this historic sale? The Boston Celtics $6.1 billion sale is already shaking up the sports world. Now, all eyes are on Bill Chisholm and Sixth Street Group to see what they do next. Now, if you've ever said that you wanted to go ahead and order DoorDash, but you wanted to pay later, that may be coming true now, because Klarna has a huge move partnering with DoorDash ahead of the IPO. Now, this may not be the best thing for your finances, but buy now, pay later giant Klarna is making headlines again, this time by securing a major partnership with DoorDash as it prepares for a much anticipated IPO. The deal is seen as a strategic move to strengthen Klarna's position in the buy now, pay later market and enhance its valuation ahead of going public. Now, Klarna is going to team up with DoorDash and will now offer its buy now, pay later services on DoorDash, allowing users to split payments for food deliveries over time. It's honestly, for the personal finance side, it is a little sad. Pre-IPO boost, the partnership is expected to drive higher transaction volumes and strengthen Klarna's market share, which will be a key factor as it gears up for an IPO. Now, Klarna aims to stay ahead of rivals like Affirm and Afterpay by expanding its buy now, pay later services beyond retail to include everyday expenses like food delivery. Now, Klarna's collaboration with DoorDash is a bold move aimed at solidifying its dominance in the buy now, pay later space. Now, will it pay off as the company prepares for its IPO? We're going to find out. Domino's pizza prices have barely changed in the last 26 years. And the question is, how? How has Domino's kept its pizza prices so low for decades? Despite economic turbulence and soaring food costs, Domino's has consistently managed to offer deals like the $7.99 large pizza, just $1 more than its $6.99 deal from 1999. So let's break down why Domino's might be the most inflation-proof pizza chain in America. Number one is they have a volume strategy. So Domino's focuses on selling more pizzas at lower margins. And the higher the sales volume, the better their profit margins, even when prices stay low. And by producing ingredients like dough in-house and selling them to franchises at low cost, Domino's boosts its profit margins. And while pizza prices remain low, Domino's has increased its delivery fees from around $1 in the early 2000s to nearly $5 today, compensating for the reduced profit margins for cheap pizzas. And Domino's invests heavily in marketing, making sure its value deals are always in the spotlight. Now, why does this matter? They do have consumer loyalty because the low prices and effective marketing continue to draw in budget-conscious customers. And Domino's success through volume and efficiency highlights why other pizza chains like Pizza Hut struggle to keep up. Now, if Domino's continues to win the volume game, will other pizza chains have to adopt a similar strategy to survive? Only time is going to tell. But Domino's seems to have cracked the code for profitability through efficiency, volume, and smart marketing. But will that strategy hold up as inflation continues to challenge the industry? We're going to find out. But in any event, it is amazing that they've kept their prices the same. Now, lastly, is we are going to do a Friday education segment. We're going to kind of talk through what happens when the Fed changes rate. Now, this week, there was a lot of interest rate talks, and the Fed may be lowering rates 2 more times later on this year. Jerome Powell has indicated that that may be the case over the course of the next couple of cycles. And so what we want to understand is when the Fed lowers rates or when they raise rates, what happens. So when the Fed lowers rates, they call this an easing policy. And when they do this, borrowing becomes cheaper because lower interest rates make loans like mortgages and auto loans and even business loans more affordable. And this encourages people and businesses to borrow and spend. But it also stimulates economic growth because it increases borrowing and spending that lead to higher consumer demand. But it can also increase inflation. So as rates go down, inflation can go up. So if you remember during COVID-19, they started to really decrease rates, but inflation rose significantly because as that spending rises, pricing may increase if supply can't keep up with demand. Now, this also encourages investment. And this is why the stock market makes moves, is because lower rates make it cheaper for companies to finance new projects, expanding operations, and boosting employment. But it weakens the dollar. So a negative thing is it can weaken that dollar, and lower interest rates can reduce demand for the dollar from foreign investors. But stocks will usually tend to rise, and investors are more willing to take risks in a low rate environment, boosting stocks, especially growth stocks, and bond prices typically increase. So lower interest rates make existing bonds with higher yields more attractive. So bond interest rates and bond prices work opposite of each other. So when the Fed raises interest rates, meaning they're tightening the policy, borrowing becomes more expensive, it slows economic growth, it reduces inflation. So if inflation is really high, that is when you start to raise rates, which is why they started to do that over time after the COVID-19 inflationary times. It discourages investments, it strengthens the dollar, and the stock market tends to fall, but not always. I mean, these are things that tend to happen. They don't always happen, but it's good to know why we even care about the Fed raising or lowering rates. Now, if you're a long-term investor, this kind of stuff is not something that you want to change your investment strategy whatsoever, because the Fed changing rates is just a short-term thing that is going to make the market move. But over the long run, as you can see, the Fed changing rates does not matter for your portfolio if you are a long-term investor. But it is very important to understand what happens and why it happens, which is why I wanted to do this quick segment. Well, listen, thank you so much for tuning into The Business Show. If you know someone who would find value in this episode, share it with a family member or a friend. Also, if you enjoyed the show, please take a moment to leave a 5-star rating and review. It helps us reach more people with this message. And don't forget to follow the show on Apple Podcasts, Spotify, or your favorite podcast player. Thanks again for listening, and we will see you on Monday.